Yeah, hello students. Previous class we discussed about it. Previous class we discussed about the marginal costing techniques and marginal costing technique related practical problems. So today I will explain budget and budget control. Just wait, I will share the topic. Right. Yeah. Yeah, students. Today I'll explain about the budget and budget control. which is held in black. Right. Okay, right. So budget and budget control. Previously, we discussed about the marginal costing techniques and marginal costing related problems. Today, I will talk about the theory chapter, that is budget and budget control. After that, tomorrow next class, I will explain this budget control related problems. So budget means what? Budget control means what? So this budgeting and budget control are essential for financial planning for tools for organization. They help the resources allocation, cost control, financial decision making purpose. So if you do the budget and budget control, with the help of these budget control techniques, you can allocate the resources, you can control the cost, you can take the financial decisions properly. So that is called as a budget. That is called as a budget and budget control. Now, what is the meaning of budget control? What is the meaning of budget? First of all, budget is a financial plan for specified period, and budgeting is the process of creating the financial plan that estimate the income and expenses over a specified period. It helps the individuals, business, and governments allocate the resources effectively, efficiently, and also controls cost and achieve the financial goals. So budget is a financial plan. Simply, we can say that it is a blueprint of the organization financial plan. And what is the budget control? So budget control, the process of monitoring the controlling expenditure, the process of monitoring and controlling the expenditure against the budget. Budget control refers to the process of managing income and expenditure by the comparing of actual financial results with the planned budget. So budget control refers to the process of managing income and expenditure. Income and expenditure by comparing the actual financial results with the planned financial budget. It helps monitoring and controlling of optimization of financial performance. So what is the need of budget? So budget is very essential for the financial planning. First one is what? Budget is, it is very essential for the financial planning. And also this budget will help to forecasting the income and expenditure, income and expenses. So second point is the resources allocation. It ensure that optimal use of financial resources. So budget team, they will do where they require the money, where they require the funds. So whatever the funds are there, accordingly they are going to allocate. So allocate the budgets. And the third one is what? Cost control. So cost control means what? It prevents the overspending. So where we are spending more, it's going to reduce the cost. And unnecessary, it is going to avoid that unnecessary expenditure also. Performance evaluation. It is measure of actual performance with the against the planned budget. So that is also. Next, performance evaluation, decision making, support the strategic operational decisions making purpose, and risk management. It helps to prepare the unexpected financial challenges. So these are the all are need of the budget. And what is the objectives of budgeting? So budgeting, there are common objectives also there. Simply that, first of all, planning, setting of the financial goals, estimating the revenues and expenditure. So planning means what? We are going to set the financial goals first. Then we are going to estimate the revenues, how much we are going to receive, how much we are going to spend. So what is the receivables and what is the payments? So that all are we are going to send. And coordination. Coordination is nothing but a budgetary control refers to the alignment of various departments. Alignment of various departments and functions and financial activities within an organization to ensure that all the part of work towards a common goal. So that is also. And control, monitoring and actual spending of comparing it with the budget. So control means what? Whatever the monitoring of actual spendings, it is going to be compared with the actual budgets. So after knowing that you are able to reduce the, you are able to control the cost also. And decision making, it helps in the decision making for the forecasting of all the resources. And efficiency, ensuring that optimal use of the funds to avoid the overspending of deficit. And what is the advantage of budget? See, first, if you prepare the budget, with the help of that budget, the efficient resources utilization will happen. So why it is going to happen? You have a plan. What is the source of revenue? What is the source of expenditure? Where you are going to spend? What is the source of generating of revenue? So if you know that amount, if you know that base of funds, so you are going to use that funds properly and efficiently you are going to use. And cost control and reduction. Cost control and reduction, as early whatever I explained, that is that budget expenditure, it is going to estimate, it is going to compare with the actual expenditure. So when you comparing that, actual expenditure to budget expenditure, you are able to know that where you are overspending. So whatever you are overspending, that you are able to reduce that. Improving the decision making. So improving the decision making means what? So proper plan, proper right time in right decision we are going to take. Performance evaluation. So performance evaluation also, it is, so how much you are spending department wise, various departments, what are the departments are involving, how much you are spending, how much result, how much output is there. So that is going to be evaluate. So once the evaluation is completed, you are able to know that which department is good performing, which department is not performing good. That is you are able to find out. And better coordination and communication. So better coordination and communication means what? So this budget is engaging entire organization. So in every organization, there are different departments will involve. So all the departments, there is a coordination and communication we are going to observe. What is the essential requirements of budget control? First of all, we require clear objectives. So clear objective means what? Whatever we are going to do, if you set the financial goals properly, so according to meeting of that financial goal only we are going to be work. So clear objective is required. Top management support, active participation. See, here active participation from the leadership crucial for the successful implementation. So active participation from the leadership is crucial. It means what? In budget control and budgeting, top level management is going to be participate. So they are going to take the proper decisions. So top level management also we required. Next, realistic budget. Estimate should be practical and based on the accurate data. So realistic means what? whatever we are estimating, true estimation of that figures, it should be practical and accurate. So if you take the fake data, your result also you are going to get the fake. So that is again, it is going to give the wrong interpretation and wrong disturbances. Next, continuous monitoring and reviews. Continuous monitoring and reviews means what? Regular evaluation needed to track. Regular evaluation is needed to track deviation, make the adjustment. See, among the various departments, if you review the regular evaluation, so you're able to find out the where we are weak, where we are strong. So that continuous monitoring and review will help to the proper budgeting implementation. Organization budgetary control system. So organization budget control system, organizational chart, budget committee, budget manual, budget period, key factor. So this budget control system considers these factors. Organizational chart means what? Organizational chart means it is a graphical representation of company structure showing the relationship of in hierarchy of among the various roles and departments. What is the meaning of budget committee? Budget committee talking about the group of key executives that is responsible for the preparing, implementing, and overseeing of the budget, ensure that financial control and efficiency. This budget manuals, a document that provide that detailed guidelines, procedure, and instruction for the preparing of, implementing, and controlling budget. The budget period, the time frame which budget is prepared and implemented, such as a monthly, quarterly, yearly. So what we are preparing that budget? So how much we are preparing? How much we are preparing? How much we are preparing for what is the time period we are taking, whether we are preparing for the monthly or quarterly or yearly, that we are going to take. And key factors. The limiting factors are constraint that impact of the budget, such as a production capacity, market demand, and financial resources. So this organization for the budget control system, these are all the factors they are going to consider. What is the difference between budgeting versus forecasting? So budgeting is different and forecasting is different. A budgeting is detailed financial plan outlining the expected income and expenses. And projection of the future financial performance, historical projection of the future financial performance based on the historical and current data. So it means what? Based on the past data, we are going to estimate for the future. So that is projection of the financial performance on based on the historical and current data. And what purpose is budget and what purpose is forecasting? So purpose of budgeting, it helps the setting of financial goals and resource allocation. But forecasting is provide insight to expected trends and aids to in the decision making. And time frame. Usually budget is preparing for the specified period, but forecasting updated regularly, monthly, quarterly. Flexibility. Generally, this fixed and occasional revisions are there. Revision. And more here forecasting is the more flexible. And scope. Focus on the setting of targets. And it is focused on the estimation of the future problems only. Now let us talk about the what are the various types of budget. So first one is the master budget. Master budget means what? It is also called as a summary budget. That entire enterprise we are going to show summarize all the activities in this budget. The master budget is show the overall plan of the business for the next period. So this budget includes budgeted positions of profit and loss as well as balance sheet also. So generally, it is comprehensive budget that includes operating budget and financial budget. Next one is the fixed and flexible budget. What is the meaning of fixed budget and what is the meaning of flexible budget? So fixed budget talking about a budget that remains is constant regardless change of activity levels. So when the activity is increasing or decreasing, the budget will not change. It is always be constant. So it is always constant. So remain unchanged irrespective of the business activities. That is called as a fixed budget. Flexible budget means what? Flexible budget that is adjusted based and changes in activity levels or business or conditions. So adjust based on the activity levels. So if your activity increase or decrease, your budget also going to be increase or decrease. So it is going to be changed according to the level of output, according to level of activity. So that is different. Functional budget. Generally, functional budget means what? So departmental budget, over covering budget, sales budget, human resources budget. These all are functional budget. So functional budgets also purchase budget, sales budget, inventory budget, production budget. So that all are will come. So let us discuss one by one. First, sales budget I will explain. What is the meaning of sales budget? So sales budget is the estimate of total sales, which may be which which may be calculate it is calculated in the financial quantitative terms, and the factors to be considered for the forecasting of sales. So first we need to study the past sales, then determine the trends of the markets and estimate the made of salesman various markets of the company products and change of the business and policies and methods. And change of the business policy and methods, government policy, controls and rules and regulations of guidance, potential market. So these all are sales. Sales budget is nothing but a whatever future demand we have the sales, we are going to estimate based on the past data. So that is called as a sales budget. And current how much we sales we did, what is our opening stock, what is our closing stock, what is the sales of that current particular period, that all are we are going to decide. Production budget. The production budget is prepared on the basis of estimation of production budget period. Usually this production budget based on the sales budget only. So how much we have to produce, how much demand we have, what is the availability of raw material. So these all are we are going to consider here. So here at the end of the preparing the budget production, manager will consider the physical facilities like plant, power, factory and space, materials, labors available for the period. This all we are going to be considered because these all are influencing the production. So if the plant will not work, production is going to be stopped. So what is the production plant capacity? If plant itself is not enough, to running of that plant, we require the power also. So and what is the factory space? What is the material? Which type of raw material we are using? What is the labors are there? So available for the period. This all are we are going to be considered. And units to be produced. So desired closing stock of the finished to calculation of units to be produced. Desired closing stock of finished goods plus budgeted sales and less beginning stock of the finished goods. So that is called as a production budget. And production cost budget. What is the production cost budget? This budget shows the estimation of cost of production. So previously we talking about the production number of units which we produced and the plant capacity and what is the demand of number of units. But in production cost budget talks about it shows that estimation of cost production. The production budget demonstrates the capacity of the production. This capacity of the productions are expressed in the terms of cost in the production. The cost budget, the cost of production is shown the details in respect of material cost, labor, and factory overhead. This production cost based on the production budget and material cost budget and labor cost budget. 1 second. Yeah, production sheet budget. So it talking about the production cost of production. Show the details in respect of material cost and labor cost and factory overheads. This production budget is based on the production budget and material cost budget and labor cost budget. Production overhead budget. Production overhead budget, manufacturing the overhead budget includes direct material, direct labor, and direct expenses. The production overhead budget represents that estimate all the production overheads, that is fixed overheads, variable overheads, semi-variable overheads incurred during the budget period. The reality of that overheads included many different types of expenses, created the considerable problems. In fixed overheads, which is no remain stable irrespective of the volume of output. So that fixed overheads it is unchanged, it is constant, and a portion of manufacturing overheads of two products manufactured semi-variable cost, that is those which are partly variable and partly fixed. So that is called as a semi-variable. And controlling of production overheads and variable overheads, that is which is like to be vary with the output. When the output will change, automatically the variable overheads also change. It is linked with the fluctuation of output. Selling and distribution cost budget. So selling and distribution cost budget talking about the estimation of the cost, selling expenses, that is advertising, delivering of goods and consumers, etc. throughout the budget period. And this budget is closely associated with the sales budget. The logic sales forecast the significantly influence the forecast the expenses. What is the administration cost budget? So administration cost budget, generally, it is non-manufacturing business activities like directors' fees, managing directors, salaries, office lightings, heating and air conditions. So these all are not the not a cost, that is which are relevant to the manufacturing. To run the manufacturing smoothly, these expenses are incurred. So supporting manufacturing expenses. So that is non-manufacturing business activities like, so supervisor salaries also, director fee also, managing directors also, salaries also, so employee lighting, heating. So these all are we are going to consider. And most of these expenses are fixed. They should not be difficult to forecast. So because generally it is fixed employees we are going to set up in the administration purpose, we are going to pay the fixed salary to them. So whatever we are paying, that amount, it is estimation is very easy compared with the manufacturing expenses. They are semi-variable expenses, which may be get affected by the expected rise of fall or cost, which should be taken into the account. Generally, this budget is prepared the form of fixed budget only. Capital expenditure budget. what is the meaning of capital expenditure budget? See, first, before discussion of capital expenditure budget, what is the capital expenditure? The amount spending for the acquiring of fixed assets or fixed properties. So that is called as a capital expenditure. So this budget stands for the expenditure on all fixed assets for the duration for the budget period. This budget is normally prepared for the long period than the other financial budget. It is capital means expenditure means long-term expenditure. It includes such as a items, new buildings, land, machinery, and intangible items like patents, etc. This budget is designed under the observation of the accountant, which is supported by the plant engineer and other functional managers. At the time of preparation of budget, some important information should be observed. So, overfilling the production facilities, certain departments are revealed the planned utilization. This long-term business policy with the regarding the technical development potential demand for the certainties. So next one is the cash budget. So this is very important topic in the examination point of view also. Cash budget means what? This in this cash budget, it is a sketch of the business estimated cash inflows and outflows over a specific period of time, specific period of the time. So cash budget talks about the whatever the cash inflows are coming, what is the cash outflows are there, what is the cash inflows are there for the particular time. So what is the cash position? To know that, we are going to prepare the cash budget. Cash budget is the one of the most important and one of the last to be prepared. So generally it is detailed projection of the cash receipts and all the sources, cash payments of the all the purposes. So it talks about simply from where, from which sources are we are receiving the cash, different categories. And next one is the from where we are applying this cash. So amount where we are, from where we are receiving, and amount where we are spending, that all are we are going to discuss in the cash budget. So it is mechanism for the controlling of coordination, that fiscal side business ensure that solvents of provides the basis of forecasting and finance required to be cover up the deficiency. Yeah. Cash budget that plays the vital role in the financing management of business undertaking. Cash budget is assisting that management in determining of the future liquidity requirements of the cash budget, forecasting the business, those needed exercise in control of cash. So cash budget is that plays the vital role in the financial performance of the enterprise. So this is the various types of budgets. So from this chapter, the practical point of view, we have to prepare, that is, we require, that is, the preparation of cash budget, important, flexible budget, important, and master budget, important. So, so these three budgets are very important. Even you have to concentrate more regarding the cash budget and flexible budget only. I'll share the some problems. Just wait. See here, I'm sharing that some practical related important problems. That is, yeah, first one is the flexible budget. They given some, here I am going to give the some practical problem and solutions. Prepare the flexible budget for overhead on the basis of following data. Ascertain the overhead rates 50% and 60% of capacity. Actually, they given 60% capacity. Already they given. And they are asking again to calculate the 50%. So variable overheads they given. Semi-variable overheads they given. And fixed overheads also given. See, first of all, indirect material. Hello? చెప్పమ్మా. నేను క్లాస్లో ఉన్నా, అయిపోగానే వస్తా. రైట్ రైట్ రైట్. See, indirect material 6,000, labor 18,000, semi-variables 40% is fixed and 60% is variable. So out of these 30,000, 40% is fixed. So means 12,000 is fixed and remaining 18,000 is the variable. Means for 60% capacity, 60% is the 80,000, 18,000. Then 15% is how much? So like that we have to calculate. Repairs also 80% is fixed, 20% is variable. So this out of these uh, total 3,000 is there. Out of this 2,400 is the fixed. Remaining 800 is the 20% means how much? 20 to 600. 600 is the variable. So for 60%, 600 is the 600, then 50% is the 500. So that will change. And as it is 2,400 plus for 500, 2,900 will come. So here, this only these variable and semi-variable items only we have to do the problem. This fixed overheads. So whatever capacity they will give, this is common for all. So I will show that. For example, material. For 6,000 is 60%. For 50,000, how much? Automatically 5,000. Next, labor. For 60% is the 3 times. Next one is how much? 15,000 is the labor. Because 60% is equal to 18,000. Then 50% how much? 50,000. Semi-variable expenses. Electricity. So, semi-variable overheads. Generally, 30,000 is the total for 60%. So here in this problem, electricity, how much they given? 30,000 they given. Out of this 30,000, 40% is fixed and 60% is variable. 60% is variable means what? How we are going to calculate? That is 18,000. Okay. 30,000 into 60 divided by 100, 0, 0 cancel, 0 cancel. So 18,000. So 18,000 is the, for same 60% is equal when the 60% equal to 18,000, automatically 15,000 equal to the 15,000. Okay. 50,000 is equal to 50,000. So means what? So here instead of 18,000, 12,000 is the fixed electricity plus 15,000. 12 plus 15 total electricity charges 27,000 we are going to get. So that is, so this is 27,000. So it include 12,000 is fixed and remaining 15,000 is the variable charge. Next, repairs. Repairs also same. For 60% is equal to this one and 20% only variable charge, that is 500. So here already they given that explanation also like this. So first we have to calculate headwise, factor wise, what is the fixed proportionate, what is the variable proportionate. So Variable only additionally we have to calculate. Fixed we are not going to calculate. As it is for every capacity, as it is we are going to take. So you just go through the this working note also. So repairs is the 5,500 is the variable. 2,400 is the fixed. Total 29,000. So fixed. So fixed variable overheads depreciation for 50,000 capacity or 60,000 capacities will not change. Same. Insurance also same. And salaries also same. So total overheads. This is the 85,900 is the 50%. 93,000 is the 60%. Estimated direct labor hours 155,000, 155, 1,55,000 hours for the 50% and 1,86,000 for that. For overhead rate, total cost divided by this one. So 0.55 is the overhead for the 50% capacity. For 60% capacity, 50 paise is the capacity. So this is the problem. Yeah, this one also very important. The given expenses budget for the production. The given expenses budget for the production, 1,000 units for the factory of furnished below. The material cost is this, whatever the cost amount they given, that is related to the 1,000 rupees, 1,000 units. So for 1,000 units, material cost is 700. So it means what? Per unit cost how much? 0.70 paise. Just remember that. Labor 250. So 250 means 250 cost. Per cost is 1,000 units. How much? For labor cost, how much for 1,000 units? Simply 25 paise per labor hour. Labor per unit. And variable overheads 200, 20 paise. Selling expenses. See, this 130, 130 includes both. 20% is fixed, remaining 80% is the variable. So out of 130, 20% means how much? 26 rupees is fixed. Remaining 104 variables, 104 rupees is the unit cost. Is it clear? Remember that. And administration overheads 2 lakhs. That is when they given this bracket, it means it is fixed. Total cost is 1,480 per unit. For 1,000 units, you can add 3 zeros. So that is 1,480 into 1,000. That is 14,80,000. They given for the 1,000 units capacity. Now we have to calculate 600 units and 800 units. So same 600 units. How much? Material how much? 600 unit per material cost they given 700. Sorry. Actually, the 700 they given per unit cost. So 1,000 into 700, that 1,000 units. Now we are calculating 600 units. 600 into 700 units, 4,20,000. 600 into labor, 2,50,000. 600 into 200, that is 1,20,000. Same similarly for 8,800 units. 800 units into 700, 5,60,000. 800 into 250, 2,00,000. 2,00,000. 800 into 200, 1,60,000. So this is first heading is the variable cost. Variable cost per unit into number of units we are going to take. And semi-variable cost. Semi-variable cost. Yeah. Semi-variable cost, how we are going to take? First, that semi-variable cost, whatever is there, only the selling expenses, 1,30,000 rupees is there. So out of 1,30,000 rupees, 20% only fixed. Remaining is the variable unit, variable cost per unit. So that is 26 rupees is the 26 total cost how much? 1,000 units into 26. That is fixed. 1,000 units into 26. That is 26,000 is the fixed cost. So here I take in 26,000, 26,000. But when the number of units change, unit price also change. So that is the reason this 26,000 divided by 600 units per unit cost is 43.33 rupees. This 26,000 fixed overheads for 800 rupees, that is 32.50. That is 50. So it means what? This, whatever the 26,000 is there, that amount is completely constant and it will not be changed. Okay. So whatever the total cost is there, the total cost we are going to divide it into number of units. So generally, if the total cost, when the number of units will increase, the total cost per unit cost is decrease. And variable cost, that variable cost generally 104 rupees per unit. This 104 into 600 rupees, 62,400. And 8,000 units, 104 into 8,000 rupees, 83,200. So it means what? This variable cost is constant, but when the number of units increase or decrease, the total cost will be affected. So this semi-variable, when you are preparing the budget, semi-variable cost is very important. And fixed cost is 2 lakhs is common for all. That total cost we are dividing into number of units. That is 2 lakhs divided by 800 units for the 8,000 for 800 capacity, 2 lakh 50 per unit. And 2 lakhs cost for 600 units, 333 rupees. So here what happened? The number we are here, number of units are less. That is the unit cost will high. When the number of units are increasing, unit cost will be decreased. So this is the way to preparation of flexible budget. Yeah, next class I am going to explain that cash budget.